Welcome to TheoTRADE. This is Don Kaufman. It's October 18th, 2024. Just over 30 minutes to go to the cash close here on this Friday afternoon. The S&P futures up some 19 handles, but it is light out there, people. I'm talking about the volume, light and fluffy volume. Look, if you don't speak necessarily S&P 500 futures geek speak, the overall volume is really light. Yeah, who cares? You should care, and I'll tell you exactly why. Today's actually a big time options expiration, and with that, you would have seen maybe some fireworks. I think there's over $5 trillion coming off today at the bell. $5 trillion of options are actually going to expire at the bell today, and yet, like, you wouldn't know it by looking at this marketplace. Again, it's light out there, really light. All right, so there's some really interesting occurrences going on throughout the course of this week. The big one, though, election risks are fading. And that's exactly what we're going to focus here, of course, on this weekend's update, is what that really means for the marketplace. In fact, I'm going to show you that, again, quite definitively, some of the election risks are absolutely starting to fade. That means there's a degree of certainty, if you will, in the air for the election upcoming. And now you're starting to see, again, a couple of aspects drop, of course, including volatility, which we'll get to, but there's a lot more than just that. All right, first and foremost, let's just talk about the market as a whole. So we have had effectively an upside break in the S&P 500, and something I've been showing quite extensively as of late is a 30-day 1 hour. Again, the 30-day 1 hour. I'm going to go ahead and close up this left side bar, and what I was zeroing in on the last couple of weeks, okay, is this just incredibly tight range that we've been trading in. I mean, for the most part, the range has been basically 5,800, 5,700, and really just kind of like pinging back and forth in that range. The unusual aspect of this is we have this break to the upside. And what we didn't see, though, in the break to the upside, okay, is vicious or unruly trade. And it's exactly what we would have expected. Like, we would have looked for, like, the break to the upside to be huge, at least, okay, exploding to 6,000. This, okay, is not furious. This is absolutely the opposite of that. We broke to the upside of this range, and trade right now, okay, is inexplicably quiet. And there's a lot of data points still coming out. The marketplace, again, kind of felt just like, shocked. And I was talking about that in last week. Fear was still gripping the marketplace, and I can see some of the fear kind of coming out. The S&Ps, though, they're simply not picking up a huge amount. Now, okay, the interesting aspect of trade, before I go too detailed into like election risks and so forth, the interesting aspects of trade are what the drivers are this week, one of which has happened to be the financials. So if we actually bring up the financials, the XLF, okay, and we bring up expected moves, what you're seeing in here is the financials last week cracked to the upside of the expected move. This week, cracked outside the upper edge of the expected move. And why I'm actually bringing up the financials is, well, because frankly, not that much else really was a driver behind it. You would think, oh no, Don, it's the NASDAQ. I mean, come on. Would you look at Netflix? Like, look at the NASDAQ. Let's do it. NASDAQ last week, kind of middle of the road. It definitely rallied a little bit, but last week, pretty negligible. This week, this is unchanged. NASDAQ's unchanged. And that, right off the bat, I wanted to kind of grab you, and kind of surprise a little bit, like, surprise, the NASDAQ actually is not per se appreciating this week. And when you start looking through what I would kind of term some of the usual suspects of tech, of course, you're going to bring up like Microsoft in here, and we're going to go through some of the usual suspects. Microsoft's completely and totally unchanged. Apple, all right, you got me here. Apple's actually got a wicked bid to the upside. Okay, Amazon, completely and totally unchanged, was down until today. Google's completely unchanged in the week. Meta, interestingly enough, Meta is actually halfway to the lower edge of the expected move. Tesla's unchanged in the week. And of course, you're going to look at NVIDIA and like, it was smoke. Look, it's not smoking. It was smoking to the upside. No, it's about, a little over halfway home to the upper edge of the expected move. Trade inside of the NASDAQ didn't necessarily get it done throughout the course of this week. So that's one of the reasons, like the S&Ps, they're up, but they're up largely predicated, interestingly enough, on the financials. Okay, if you take a look at the energy sector, it's not the energy sector, that's actually to the lower edge of its expected move. And those are your primary drivers right now. Look, I know everybody, well, I want to look at consumer staples. Come on, you can add up all the consumer staples and all the energy together, and it wouldn't equal, okay, what like one tech company equals. I mean, it's phenomenal out there these days. But I think it is important, okay, to denote what the driver is. And the driver this week was a very unlikely area, and that happened to be none other than the financials. Now, of course, comments can be made about the financials and like, well, this is the election, quite possibly. Absolutely, quite possibly. But I'm going to go a lot deeper than that. Let's get to it here regarding the election. And again, okay, not exactly a popular thing to talk about right now anywhere in the United States. It's a good thing I'm actually broadcasting right now from none other than the United States Virgin Islands. And I am a resident of the United States Virgin Islands, and I cannot vote for a U.S. president. You have to love that. Grew up in the States, okay? Lived there most of my life, but last 4 years down here in the U.S. Virgin Islands, can't vote for president. So it gives me the objective stance over here. So I'm going to give you a little objective stance and then some subjective nature over here as well. One of the first things, okay, worth looking at, look at the US dollar. When I say, okay, that there's election risks are fading, the US dollar is on an absolute tear right now to the upside. And you go, okay, so what does that have to do with the election? It actually has a lot to do with the election. Specifically, it has a lot to do with a Trump administration. The reason being, Trump's a tariff man. And tariffs would actually cause, both on Europe and on China. Now, Chinese tariffs are actually still in play, although those could actually grow quite substantially. There's actually a deep threat of European tariffs of some sort. And as such, you can see the euro getting absolutely smashed. So as we get closer to the election, I think that, and again, this is the subjective nature of it, is I actually think that most of that move is probably already played out. Even if we pulled back a little bit, that doesn't necessarily diminish, okay, the market's expectation. And again, the objective nature is this, like, look, this is, if you will, rallying the odds, okay, of a Trump administration, plain and simple. And there's a lot to actually support that. Now, with that, because of tariffs, I mean, ultimately, what do? I want to avoid some of those tariffs. There's a lot of people buying US dollar. And this, by the way, this is, you're like, well, they can manipulate betting markets and betting markets. I think betting markets are showing anywhere from a 58 to 60% probability right now of a Trump administration. Of course, you would argue all day long, those can be manipulated. I agree. They probably can because they're small enough to do that. You're not going to manipulate the United States dollar. We're talking trillions of dollars to make this move. Now, to further that, okay, you're also now looking at VIX. So why is VIX actually coming off? In fact, if you look at VIX, you're like, oh, that's almost the exact opposite of the US dollar, of course, because once we start to, come into like, hey, wait, the election might not be, the big unknown that we think it's going to be. Well, so the volatility starts coming off. And every aspect of volatility is coming off to some degree. And one that's really important is VVIX. This is the volatility index. It too has actually gotten crushed down. In fact, I saw an article out the other day that on Wednesday, VIX options expired on Wednesday. And right now, we actually have the lightest call open interest that we've had in 2.5 years on VIX. So the VIX options themselves, are, again, light on open interest. And if you're not familiar with VIX calls, that basically implies there's not as nearly as many people hedging out there. Now, there is one contrary indication over here. Skew is still sky high. Okay, the skew is still one of the highest on records, which is simply indicative of saying, like, look, okay, the SPX, okay, is still being used as a hedge. So on one hand, we're like, all right, so in terms of the volatility product, VIX itself doesn't look like a lot of people are necessarily renewing hedges in VIX. Again, the election risks are fading. There is still a tremendous amount of hedging specific to skew, okay? But again, we'll keep an eye on this in days to come. So a little bit of a contrary indication over there. Now, there's other places you can look, and this is much more, not nearly as objective, but you can actually look at Trump media itself. Also, again, I'm just going to put you back in a daily chart. Look at Trump media. There's a huge bid back under it. And I say this part's subjective because, sure, people are actually, running into the stock and so forth, but it also looks a lot like the US dollar. Again, I think this is far more subjective than would be looking at the United States dollar, which is, you're not going to manipulate this. Now, just because you see the dollar up doesn't necessarily mean, though, you can see continuation. Okay, the trade may already be largely priced in. Okay, the VIX has now faded quite substantially. This is one of the lower prints we've seen in the VIX now. Okay, here you have to go all the way back to the beginning of the month to actually see that. So we're in a lower volatility climate. This actually, if the VIX continues to actually fall to some degree, obviously it's giving higher probability to election, being over and done with. All right, I wanted to get that out of the way. Again, it's not meant to offend anybody, but it is marquee right now for the markets. It just is. So how can that actually impact the S&Ps? This is a bit of a catch-22 because immediately people are going to prognosticate, if Trump's elected, the markets are going to explode to the upside. Why? Because that's exactly what happened in 2000, in the 16 time frame. In this particular case, though, they would be talking about government spending, okay, being clipped in a very significant fashion, which, okay, is directly responsible for a huge amount of present GDP. That is not per se bullish for markets. And I'm not trying to paint necessarily a negative picture, but you could look at this marketplace right now, simply put, could be a buy the rumor, sell the news. You got to be careful still coming into the election because you're going to come into the election with a lower volatility climate. Things are going to subside, and all of a sudden the S&Ps could get all kinds of squirrely, especially if government spending is going to be clipped. So why do I actually talk about government spending being clipped? Because we've all actually heard Elon Musk in the last couple of weeks and last few months talking about efficiency of obviously government. So again, I'm trying to keep this as high level, okay, as absolutely possible and as simple as absolutely possible. We can get infinitely deeper, but the more you actually look at volatility and the structure of volatility, the more you start to realize, those election risks are absolutely fading. People are actually getting in alignment right now, specifically for the possibility of tariffs out there, okay? All the pieces are actually coming into play right now. Again, anything can shift. Anything's plausible. The one aspect that I would say is the most uncertainty to me are these S&Ps, because as I said, I don't necessarily construe, okay, a Trump administration as being bullish per se for the S&P 500. I think you can make great arguments for the dollar, okay, and other products, but not necessarily for the S&P. Speaking of that, let's actually move onward and upward. Oil, okay? Oil in the near term could actually be opportunistic. Now, oil is another aspect. Although we see oil having some sell-side activity, you would think, oh, that's because tensions in the Middle East might be abating, possibly. Or, okay, this could also be heavily involved in what? Election risk, right? And the election risk starts to fade. Why? Trump administration, it's about drill, baby, drill. So all of a sudden you actually see oil prices coming down. In the near term, I believe oil's actually come down a bit too much. This may actually have legs. A long position in oil in the near term, okay, might suffice. That's something I'm going to look at specifically for early next week. If we see a little bit more sell side activity, and what do I base this on? Okay, well, I do look a lot at these expected moves, and we actually cracked through the lower edge of expected move in oil. I'll actually see into Monday and Tuesday. If we actually head to the downside again, I'm very likely to take a bullish position and look for a bit of a bounce to occur anywhere in the mid $66 a barrel, okay, handle. I actually might jump in there just for a bounce back in oil, not necessarily a long duration position, because as I just said, there's implications of oil as well under the election. So, we're looking at a number of products over here, including, oil's down. Yeah, it can definitely be election risks fading. Okay, obviously you got the dollar ripping to the upside. Now with the dollar ripping to the upside and volatility falling, okay, there's another portion of this picture that I want to bring into the equation. And this one is actually both perplexing and bothersome. It is my interpretation looking at markets that inflation, okay, is absolutely making a comeback. Now I say, my notes over here, inflation making a comeback, question mark. No, I actually think inflation is making a comeback, largely predicated on the idea of just look at gold. Now, you got to remember that gold is priced in US dollars. And what is gold doing? Okay, smashing to the upside, all right, hitting through the 2,700 mark for the very first time. So why do I care? Oh, it's breaking to the upside. I care because gold is breaking to the upside on an incredibly strong US dollar. And that, people, is all kinds of chaos. This is inflation hedging like I've never seen before. Now, with that in play, it goes a lot deeper than just that. The other thing, when I talk about inflation, this happens to be the 5-year and this is the 10-year. You turn on mainstream media, they'll tell you interest rates are coming down. The Fed is cutting. Really? Interest rates are coming down, huh? Because for the last month, and it's literally a month, right down here, those lows, all right, about what? Mid-September, September 16th, we were trading 3.6%. Now we're actually clear up to 4.1%. I was talking about this the other day, okay? But I have got to give you caution on this front, because here's another aspect that can really, it does not set me at ease inside of the S&P 500, not by any stretch of the imagination. We may have inflation that comes back, and the Fed may actually have to adjust future policy, largely predicated on look, they're going to look at asset prices, just like we're looking at asset prices right now. What do you see when you look around? What do you really see? Well, Don, I see the S&P's at an all-time high. Great, I see that too. I see the Dow at an all-time high. I see that too. I also see gold at an all-time high. That's a little bit of a warning shot out there. Everywhere you look, asset prices are basically at all-time high. What is not inflationary about that? Everything you're looking at is inflationary, check, inflationary, check. The only thing that's not inflationary right now, you could probably argue, is oil. And oil, though, well, geopolitical risks, okay, that could make a comeback in a big way. This is dicey at best. So there is just a huge amount to think about, though, okay, because the S&Ps, as I said, this is the product that's actually got me in the most edge. One of the things I'm going to look at specifically for next week, are we actually going to make a drop right back in and under this 5,800 range? Okay, we're 100 points north of that 5,800, 5,700 range. And the reason I'm looking for the possibility of the pullback into that particular range is, again, we didn't come out of the range in the fierce nature that we anticipated. I think there's actually a little bit, okay, of a top-heavy marketplace right now. And even if we are going to continue higher, I think we have to consolidate and pull back prior to effectively doing that. All right, last thing I want to mention here, of course, on this weekend's update, ladies and gentlemen, you know it, you see it. This, okay, is wildly unusual. We now have 4, count them, 4 consecutive weeks of being inside the expected move and never touching the upper or lower edge of the expected move. There's 1, 2, 3, and now 4 weeks in a row, okay? I've actually been recording data since 2017. There's only one other instance of this occurring, especially in what can be construed as a slightly higher volatility climate. As such, okay, so you're like, oh, who cares? We didn't hit the upper or lower edge of the expected move. That's right. This next week, okay, you basically, stick a fork in us, we're done, right? There hasn't been a time. It's not saying that it can't happen, but there hasn't been a time that we have not hit the upper end or lower edge of an expected move. Now, next week, okay, we are looking for approximately about $73 of anticipation and movement. So let's actually put that up here. So the expected move, and this is not set in stone yet because obviously there's still some time left. The expected move is plus or minus about $73. It's about $73. Now, last week's expected move, okay, was 87.91. This is a fairly significant crush in volatility. Again, it furthers that logic, okay, that, well, the election risks are still kind of coming off. So, expected move. Well, I think you should expect me to do a butterfly on one side or the other again next week, looking for markets to hit the upper edge and or lower edge of that expected move throughout the course of the week. Those SPX butterflies can be wildly profitable, okay, if we actually hit upper or lower edges of expected move. That's a trade that I'll, of course, be pulling out early on, of course, in this next week of trade. Nevertheless, as I said, look, election risks, they're fading. Volatility is starting to crush. The big unknown right now, okay, it's not so much right now about NVIDIA. It's not so much about, tech in general. Even though some big earnings are coming out, right now, okay, it's about the S&Ps. They're just stuck in the middle with you, slow markets. And look, don't let this get off your game over here. Just because markets are slow this week, okay, we'll spark back some volatility in no time at all. With that, thanks everybody for joining us here at TheoTRADE. Have a wonderful weekend. Bye-bye.